Buffett's two-step stock market strategy, authored by Danial Jiwani, distills the legendary investing principles of Warren Buffett into a concise framework. This book provides a roadmap for both novice and seasoned investors to outperform Wall Street using a simple yet powerful approach to investing. Let's explore this strategy, supported by real-world examples and insights from the book. The introduction. Simplifying investment wisdom. The author opens by asserting that investing need not be complicated. Drawing inspiration from Buffett, Jiwani emphasizes that successful investing requires logical principles and clarity of purpose. The book's two-step framework is designed to help investors identify excellent companies and purchase them at the right price. A straightforward, yet profound approach that has stood the test of time. Jiwani argues that everyday investors have distinct advantages over mutual fund managers. For instance, fund managers often face constraints like excessive diversification and client demands, which hinder their ability to seize lucrative opportunities. In contrast, individual investors can act decisively, investing only in the best opportunities without being burdened by these limitations. The key is to cultivate a disciplined mindset and focus on long-term value creation. The ultimate principle of investing. The foundation of Buffett's strategy is rooted in a fundamental principle: businesses are purchased for their ability to generate cash. This perspective shifts the focus from short-term price movements to the long-term potential of free cash flow, the true measure of a company's profitability. To illustrate, imagine you're considering buying a car dealership for $1 million. Despite breaking even in the first year, the dealership is projected to generate $500,000 annually in free cash flow thereafter. This promising cash flow makes the investment attractive. Similarly, when evaluating stocks, Jiwani urges readers to think like business owners, prioritizing cash flow potential over superficial metrics like the price-to-earnings (PE) ratio. Buffett's philosophy is clear. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The book underscores the importance of understanding a company's ability to generate consistent and growing cash flows, which ultimately determine its intrinsic value. Pitfalls of misguided metrics. Jiwani cautions against over-reliance on conventional metrics, such as the PE ratio. While a low PE ratio might indicate undervaluation, it often fails to capture the nuances of a company's true cash-generating capacity. For example, net income figures may be skewed by non-cash charges like depreciation, rendering the PE ratio an incomplete metric. Instead, the author champions free cash flow as the ultimate gauge of a company's financial health. Unlike net income, which is influenced by accounting practices, free cash flow provides a clear picture of the cash a business generates and retains for growth, dividends, or debt reduction. Step 1. Finding a wonderful business. The first step of Buffett's framework is identifying a wonderful business. According to Jiwani, such businesses possess 4 key characteristics: a durable competitive advantage, or moat, a slowly changing industry, predictable free cash flows, and strong financials. Characteristic 1. A durable competitive advantage. Strong moat protects a company from competition, ensuring its profitability over time. Jiwani categorizes moats into 3 types. Brand strength. Companies like Apple and Starbucks leverage their brands to build customer loyalty and trust. For instance, Apple's iPhone dominates the youth market, not because it's technically superior, but because it's perceived as cool and synonymous with quality. Exclusive rights. Firms with intellectual property, such as patents or copyrights, enjoy a natural moat. Activision Blizzard, for example, secures its dominance in gaming through exclusive rights to franchises like Call of Duty. Market position, businesses that serve as essential service providers in a specific region, such as waste management in waste disposal, face minimal competition due to high barriers to entry. Jiwani emphasizes that a strong moat is essential for long-term success. Investors must assess whether a company's competitive advantage is sustainable and superior to its rivals. Characteristic 2. A stable industry. Wonderful businesses often operate in industries with minimal disruption. Rapidly changing sectors like generic software are fraught with uncertainty as competitors continually innovate and erode each other's advantages. By contrast, industries with steady demand and slow change, such as consumer goods or utilities, offer a more predictable environment for investment. Characteristic 3. Predictable free cash flows. Consistency in free cash flow generation is a hallmark of a wonderful business. This predictability allows investors to estimate future earnings with confidence, reducing the risks associated with volatile or speculative investments. Characteristic 4. Strong financials. Lastly, financial health is non-negotiable. Investors should scrutinize key metrics such as revenue growth, profit margins, and debt levels. For instance, a company with a high return on invested capital, ROIC, signals efficient use of resources to generate profits. Jiwani advises targeting companies with ROIC above 10%, as this reflects superior management and operational efficiency. Step 2. Determining a wonderful price. After identifying a wonderful business, the next step is determining the right price to pay. Jiwani highlights the importance of patience and discipline, as even the best businesses can become poor investments if purchased at inflated prices. Valuing a business. The book introduces valuation methods centered on free cash flow. By comparing a company's current cash flow to its stock price, investors can estimate its intrinsic value. If the market price is significantly below this intrinsic value, the stock presents a buying opportunity. For example, suppose a company generates 10 million in annual free cash flow and is priced at 100 million in the stock market. This translates to a price-to-free cash flow ratio of 10, indicating the investor pays $10 for every $1 of cash flow. Such a valuation may be attractive if the company demonstrates strong growth potential and financial stability. The margin of safety. Buffett's concept of a margin of safety ensures that investments remain profitable even under adverse conditions. By buying at a significant discount to intrinsic value, investors can mitigate risks and enhance potential returns. Avoiding emotional pitfalls, Jiwani warns against the emotional traps that often plague investors. Greed and fear drive many to buy high during market euphoria and sell low during downturns. He advises maintaining a rational, long-term perspective, using market volatility as an opportunity to acquire quality stocks at discounted prices. Common mistakes and lessons from the masters. The dangers of over-diversification. While diversification is a common investing mantra, Jiwani cautions against overdoing it. Holding too many stocks can dilute returns as it becomes challenging to monitor and manage a large portfolio. Instead, he recommends concentrating investments in a select few high-quality businesses with proven track records. When to sell. Knowing when to sell a stock is as crucial as knowing when to buy. Jiwani outlines scenarios that warrant selling, such as fundamental changes in the business that undermine its moat. Overvaluation that significantly exceeds intrinsic value. Better investment opportunities elsewhere. By adhering to these principles, investors can maximize their returns while minimizing unnecessary churn. real-world examples and practical applications. Throughout the book, Jiwani reinforces his points with relatable examples and anecdotes. For instance, he recounts the story of Ronald, an investor who lost 85% of his portfolio by speculating on short-term price movements. By refocusing on fundamentals and adopting Buffett's strategy, Ronald regained financial stability and achieved long-term success. The book also draws parallels between investing in stocks and purchasing real estate. Just as a property's value depends on its ability to generate rental income, a stock's value hinges on its cash flow potential. This analogy simplifies complex concepts, making them accessible to readers of all backgrounds. Conclusion: empowering everyday investors, Buffett's two-step stock market strategy is more than an investment guide. It's a call to action for individuals to take control of their financial futures. By demystifying the stock market and providing a clear, actionable framework, Danial Jiwani empowers readers to think and invest like Warren Buffett. The book's enduring message is that success in investing requires discipline, patience, and a focus on fundamentals. Whether you're a seasoned investor or just starting your journey, following this strategy can help you achieve superior returns and financial independence.